Hello, I'm David Hefty, Chief Executive Officer of Credent Wealth Management.
And I'm Edison Byzyka, Chief Investment Officer.
As you're likely aware, the stock market environment since early March 2020 has been one of historic proportions. Not only has the quick pace of downside established new records, but the short-term upside has also shattered historical records. This does not surprise us, and it's something we discussed in our March 25th video commentary on the topic of how to become a proactive bear market investor. We now know that the release of that video coincided with the market bottom just 2 days prior. The S&P 500 has gained over 20% since that date and through April 22nd.
We do our best to remain objective in our multi-strategy investment platform to make you a better proactive bear market investor. But we also understand that sometimes there can be emotional roadblocks driven by clients. Economists refer to this as behavioral finance, and we believe it applies dominantly in the current bear market. One of the first behavioral finance biases we can often fall victim to, especially in the current environment, is called anchoring bias. And this simply says that investors sometimes fail to look beyond the current set of news, and we're often anchored in our decision-making only on initial pieces of information, irrespective of how positive or negative they may be. This can often lead to misguided decision-making due to the unwillingness to further expand our information data set.
Yep, and once investors fall victim to the anchoring bias on an initial set of information, many are subject to confirmation bias. Such a bias can result in the tendency to search or interpret new information in a way that confirms and strengthens one's initial view. In other words, we purposely avoid the opposing point of view and neglect to place much emphasis on arguments that significantly differ from our own. We believe confirmation bias can be the most detrimental in a bear market. The reason for that is because bad news is often easier to acquire than good news when we're in a bear market. If we fail to analyze information that has potential for market upside, an investor can be left behind.
That's right. The last behavioral bias we want to focus on today is the notion of hindsight bias, which occurs when we place too much emphasis on historical relationships as a means of gauging what may happen in the future. As an example, it's very easy to associate the current economic and market environment with what we experienced in the global financial crisis of 2008. The narrative for that comparison may make sense, but we urge caution in attempting to compare events in that manner. In this particular example, the structural bear market of 2008 does not quite compare well to the event-driven bear market of 2020. They are fundamentally different, as is the case with numerous other data points.
That's right, Edison. The chance to become a proactive bear market investor is not lost. If you have questions on how to best accomplish that, please contact one of our financial advisors.